On September 15, 2008, Lehman Brothers, once the fourth largest investment bank in the U.S., collapsed, triggering the largest bankruptcy in American history. The shock was instant. Global markets plunged, and the world watched as a 158-year-old institution vanished overnight. Lehman's name, once a symbol of stability, became synonymous with disaster. The fallout was personal. Over 25,000 employees lost their jobs in a single day. Images of stunned workers leaving with boxes captured the human cost. This wasn't just a business failure. It was a crisis of trust in the financial system itself. Lehman's collapse exposed deep flaws in global finance and set off a chain reaction threatening other major banks. Understanding how this happened is crucial because the lessons from that day still echo today. But Lehman's story began long before the crisis, in a small family business in the American South. Let's go back to where it all started. Lehman Brothers began in 1844 as a dry goods store in Montgomery, Alabama, founded by three German immigrant brothers. They accepted cotton as payment, transforming their shop into a commodities business. After the Civil War, they moved to New York and helped found the New York Cotton Exchange. Spotting new opportunities, they shifted from trading goods to financing America's industrial boom. Lehman Brothers became an investment bank, raising capital for railroads and oil companies. Over the next century, they survived depressions, wars, and market crashes, building a reputation for resilience. By the 1980s and 90s, the firm was driven by a high-risk, high-reward culture. In the 2000s, Lehman was a global powerhouse, making record profits and earning Wall Street's respect and fear. But inside, a dangerous bet on the housing market was brewing. The ambition that built Lehman was now pushing it toward disaster. Lehman's downfall began with a risky bet on the U.S. housing market. As home prices soared, Lehman invested heavily in subprime mortgages, loans to people with shaky credit. They bundled these risky loans into mortgage-backed securities and sold them to investors. Then came collateralized debt obligations, or CDOs, complex products that promised big returns but hid massive risks. Lehman kept the riskiest slices for itself, convinced the housing boom would never end. To fuel these bets, they borrowed huge sums, over $30 for every dollar they owned. This leverage magnified profits, but also potential losses. The entire business depended on home prices rising forever. For a while, profits soared and warnings were ignored. But Lehman had built a financial skyscraper on sand. It only took a small tremor to bring it all crashing down. In 2007, the housing bubble burst. Subprime borrowers defaulted, and Lehman's mortgage assets became toxic. The firm's billions in securities were suddenly worthless, and no one wanted to buy their bad assets. Lehman's stock price collapsed as panic spread. CEO Richard Fuld insisted the firm was safe, but behind the scenes, desperate attempts to find a savior failed. Other banks, facing their own troubles, refused to take on Lehman's risk. In September 2008, the U.S. government, which had just rescued Bear Stearns, refused to bail out Lehman. Private rescue talks collapsed. No one wanted to take the risk without government backing. On September 15th, Lehman filed for bankruptcy. The news sent shockwaves through global markets, freezing credit and triggering a worldwide financial meltdown. The fall of Lehman turned a crisis into a catastrophe. Why wasn't Lehman saved? Just months earlier, the government had rescued Bear Stearns. But by September 2008, public anger over bailouts was intense. Officials wanted to send a message: no more endless rescues for reckless banks. Legal obstacles and lack of collateral made a bailout difficult. Private buyers like Bank of America and Barclays walked away when the government refused to guarantee losses. Letting Lehman fail was a calculated risk, one that backfired. Officials underestimated how deeply Lehman was tied to the global system. Its collapse triggered a cascade of failures and forced the government to bail out AIG days later. The lesson: unchecked risk and fragile confidence can shatter the world economy in an instant. To understand today's world, we must remember the day Lehman fell. Subscribe for more stories that shaped our times.